Welcome to our deep dive into 9 advanced and profitable trading strategies. Whether you're new to day trading or looking to refine your approach, this video will walk you through proven methods used by successful traders. We'll explore strategies that work across forex, commodities, and stocks, and discuss the importance of discipline and money management. By the end, you'll have a toolkit of actionable tactics and a better understanding of how to manage risk for long-term success. Let's get started by understanding what sets winning traders apart and how you can apply these principles to your own trading journey. Successful day traders consistently do three things. They use tried and tested strategies, execute them with unwavering discipline, and follow strict money management rules. These habits are crucial for anyone aiming to trade for a living, especially when using their own capital. While professional traders may have access to institutional funds, individual traders must be even more cautious. In this video, we'll focus on strategies that maximize your chances of staying in the game for the long haul, helping you grow your capital steadily and avoid common pitfalls. Many new traders wonder how to find day trading strategies that actually work. The reality is, only a small percentage of people succeed in day trading, and those who do often rely on systematic approaches. By dedicating just a few minutes each day to learning and applying these strategies, you can significantly improve your chances of success. The strategies we'll cover are suitable for various markets and can help you turn your starting capital into a substantial nest egg over time. This video will introduce 9 powerful trading strategies, explain the main chart patterns associated with each, and provide step-by-step instructions for implementation. We'll also discuss essential risk management techniques to help you stay profitable over the long term. By learning to use even basic intraday trading strategies, you can cut your losses and increase your profitability. Let's dive into the first strategy, momentum reversal trading. Momentum reversal trading strategy combines fundamental and technical analysis to spot market reversals. First, analyze the fundamental aspects of the traded asset to determine the mid to long-term trend. Then, use price momentum, support, and resistance zones to identify potential reversal points. This approach allows you to enter the market with low risk and high profit potential. Trades are planned in advance, often as pending limit orders, and typically executed during major market sessions. The strategy works well on major currency pairs and can be held for several weeks depending on price action and fundamentals. Implement the momentum reversal strategy. Use a few key indicators: the stochastic oscillator multi-time frame, support and resistance levels, and Fibonacci retracements. Start by establishing your bias and long-term trend, then switch to daily charts to look for price reversal phases. Ask yourself, has the market been trending? Are stochastics showing overbought or oversold levels? Is the price near major support or resistance? These questions help you pinpoint high-probability reversal zones. Let's look at a real-world example using the USDJPY daily chart. Here you can see several instances where the price entered a reversal phase. For example, when weekly and daily stochastics are above 70 and the market has rallied, mark this zone as bearish and look for reversal patterns on intraday charts. Similarly, when the price is overbought and near resistance, it's a signal to prepare for a bearish reversal. Conversely, when the price is oversold and near support, consider a bullish reversal. Always align your trades with the established trend from your fundamental analysis. Moving average crossover strategy is a classic approach that uses 3 moving averages: a fast 20 period, a slow 60 period, and a trend indicator 100 period. A buy signal is generated when the fast MA crosses above the slow MA, and a sell signal when it crosses below. If price bars stay above or below the 100 period MA, it indicates a strong trend. This method helps you follow trends and avoid emotional decisions, as every trade is based on clear, calculated signals. The EURUSD daily chart, the moving average crossover system, generated several profitable signals over 6 months, with gains of 600, 200, and 100 points. However, it also produced some false signals during rallying markets. The key is to recognize when the market is trending and when it's not. By sticking to the strategy, you remove guesswork and base your trades on objective criteria, leading to more controlled and decisive trading. This detailed example, the fast MA crosses below the slow and trend MAs, signaling a strong downtrend. The price quickly moves away from the trend MA and stays below it, confirming the trend's strength. This setup allows traders to ride significant moves while minimizing exposure to false signals. Remember, the strategy isn't perfect, but it brings discipline and structure to your trading decision. Not every signal will be profitable. Here, a false signal occurs when the fast MA moves above the slow MA, only to reverse quickly. While the system isn't always right, it still provides a framework for making rational decisions. Over time, using a consistent technique helps you avoid emotional trading and stick to your plan, which is essential for long-term success. Heikin-Ashi trading strategy uses a unique chart type that smooths out price action, making trends and reversals easier to spot. Unlike standard candlestick charts, Heikin-Ashi candles are calculated using averages, which helps filter out market noise. This strategy is especially useful in volatile markets, as signals are delayed but more reliable. Traders wait for daily candles to close before making decisions, reducing the risk of false entry. A Heikin-Ashi chart, bullish candles are typically green and bearish candles are red. The strategy involves waiting for 2 consecutive candles of the same color to confirm a trend reversal. For example, after a series of green candles, 2 red candles signal a potential short setup. Conversely, after a series of red candles, 2 green candles indicate a possible long setup. This method is simple yet powerful, especially when combined with momentum indicator. For a short setup, look for 2 consecutive red candles after a series of green ones. This suggests the uptrend is exhausted and a reversal is likely. For a long setup, 2 green candles after a series of red ones indicate the downtrend is ending. However, candle patterns alone aren't enough. Use additional filters such as the stochastic oscillator to confirm overbought or oversold conditions and improve your trade's probability of success. Further refine your entries, use a stochastic oscillator with settings 1473. Enter a long trade after 2 red candles and when the stochastic is above 70. Enter a short trade after 2 green candles and when the stochastic is below 30. For added safety, place stop orders a few pips above or below the reversal candles. This layered approach helps filter out false signals and increases your chances of catching significant market move. Another useful filter is the accelerator oscillator, which works well on daily charts. For long trades, wait for 2 green candles and a green bar above the zero line on the oscillator. For short trades, look for 2 red candles and a red bar above the zero line. This confirmation step helps ensure you're trading in the direction of real momentum, not just a temporary fluctuation. Reversal pattern is only valid if 2 consecutive candles are fully completed on daily charts. Avoid entering trades immediately after volatile swings or during major news events like central bank speeches or economic releases. Good timing and patience are essential. Always consider the broader market context and fundamental news before making a move. Effective money management is crucial. Move your position to break even after a 50-pip profit and adjust your stop loss to major local highs or lows or when an opposite signal appears. Let your winners run, but always protect your capital. Use a flat 100-pip stop loss or set stops based on technical levels. Every trader should develop their own money management rules to suit their risk tolerance. Let's look at a real trade example. On May 22, 2013, a long trade was entered at 1.2922 and exited at 1.3215, resulting in a 300-point gain. This setup followed the Heikin-Ashi reversal pattern and confirmation from momentum indicators, demonstrating the power of this strategy when applied with discipline and patience. Another example, on June 21, 2013, a short trade was taken at 1.3215 and closed at 1.3087, netting a 130-point profit. Again, the setup was based on clear signals from the Heikin-Ashi chart and supporting indicators. These examples highlight how waiting for the right setup can lead to significant gains. On October 31, 2013, a short trade was executed at 1.3686 and closed at 1.3505, resulting in a 170-point profit. These real-world examples show that the Heikin-Ashi strategy, when combined with proper filters and money management, can be a reliable tool in your trading arsenal. Swing day trading strategy focuses on identifying corrections within a trend and catching the swing back into the main trend. Corrections are periods where price movement slows and overlaps, signaling a potential continuation of the trend. By staying vigilant and recognizing these patterns, swing traders can enter high-probability trades with well-defined risk and reward. This EUR/USD 240-minute chart, a correction is identified by a cluster of overlapping candles within a narrow range. When the price finally breaks below this range, it signals a continuation of the previous trend. A swing trader would sell at this point, placing a stop at the most recent minor swing high. This approach allows for tight risk control and the potential for large gains if the trend resumes. Another example shows a correction to the downside, with overlapping candles indicating slowing momentum. When 2 candles break above the correction range, it signals a reversal and a new swing opportunity. The trader buys at the open of the next candle, placing a stop at the lowest point of the correction. This trade risked about 30 points for a potential gain of 600 points, demonstrating the power of swing trading when executed correctly. Candlestick patterns are essential tools for traders. They provide visual cues about market sentiment and potential reversals. Some of the most powerful patterns include bullish and bearish engulfing, long shadow, and hammer patterns. Recognizing these formations can help you anticipate significant price moves and time your entries and exits more effectively. Bullish engulfing pattern occurs when a candle's real body completely covers one or more of the preceding candles. This signals a strong bullish reversal, especially if it engulfs multiple candles. When you spot this pattern, wait for the next candle to confirm the move, then enter a long position. Place your stop at the low of the engulfing candle to manage risk. Bearish engulfing pattern is the opposite of the bullish version. It signals a strong bearish reversal when a candle's real body engulfs previous candles. After spotting this pattern, wait for the next candle to confirm, then enter a short position. Your stop should be placed at the high of the engulfing candle. These patterns often precede significant price declines. Long shadow pattern refers to candles with a shadow at least twice the length of the real body. These often occur at market turning points and can signal large upcoming moves. To trade this pattern, wait for the candle to close, then enter at the open of the next candle. Place your stop at the extreme high or low of the shadow and trail it as the trend develops. Hammer pattern forms when the real body of the candle sits at one end, creating a shape resembling a hammer. These candles often appear at price reversals and signal strong potential for a trend change. Wait for the hammer candle to close, then enter at the open of the next candle. Place your stop at the extreme high or low of the hammer and trail it as the trend progresses. Role reversal trading strategy is based on the concept of support and resistance zones. When a resistance level is broken in an uptrend, it often becomes new support and vice versa in a downtrend. This strategy helps traders identify key areas for entering trades with high probability. Remember, support and resistance are zones, not exact prices, so always allow for some flexibility. In an uptrend, once the price breaks through resistance, that level often acts as new support, traders look to buy on pullbacks to this new support zone, anticipating the trend will continue. This approach allows for strategic entries with defined risk, as stops can be placed just below the new support area. Same principle applies in downtrends. When the price breaks below a support level, that level often becomes new resistance. Traders look to enter short positions on pullbacks to this resistance zone with stops placed just above. This method helps you capitalize on trend continuations while managing risk effectively. Further refine your entries, combine role reversal zones with other indicators like pivot points and Fibonacci retracements. For example, divide your position into thirds and set limit orders at the 20-period moving average, the role reversal zone, and the 50% Fibonacci retracement. This approach lowers risk and increases the odds of getting filled at optimal prices. Bollinger Band squeeze strategy takes advantage of periods of low volatility, which are often followed by significant price movements. When the Bollinger Bands contract and the band width approaches a low threshold, it signals that a breakout may be imminent. This strategy helps traders anticipate and profit from volatility spikes. In the EURUSD 240-minute chart, the Bollinger Band squeeze is identified by bands contracting and the band width nearing 0.01. A buy signal is generated when a full candle closes above the simple moving average, while a sell signal occurs when a candle closes below. Stops should be placed at the high or low of the preceding candle, or to limit losses to 3% of your capital. The narrow range strategy is a short-term approach that seeks to profit from volatility expansion after periods of contraction. Identify the candle with the narrowest range over the past 4 or 7 days. These candles often precede large breakouts, making them ideal for traders looking for quick moves. Once a narrow candle is identified, a buy signal is triggered when the price moves above its high, and a sell signal when the price drops below its low. Place your stop at the opposite end of the narrow candle and trail it as the trade progresses. This method allows for tight risk control and the potential for large gains when volatility returns. Here's another example of the narrow range strategy in action. After identifying a narrow candle, the price breaks out, leading to a significant move. By entering on the breakout and trailing your stop, you can capture substantial profits while keeping your risk minimal. 2-period RSI strategy is a fast-paced, aggressive approach. A buy signal is generated when the RSI moves above 90, and a sell signal when it drops below 10. This method produces many signals and is best used in trending markets. Due to its aggressive nature, it's essential to pair it with strict stop-loss rules to avoid large drawdowns during ranging markets. In this example, the RSI moves above 90, triggering a buy signal. Additional buy signals can be added as the trend continues. All positions are closed when the RSI drops below 10, locking in profits. This strategy shines when the market is trending, but caution is needed during sideways periods to avoid multiple losing trades. Trading is not a casual pastime. It requires dedication, discipline, and continuous learning. Over 93% of new traders lose money and give up, often because they lack a tested strategy, discipline, or proper money management. By recognizing these challenges and committing to a structured approach, you can avoid the common pitfalls and increase your chances of long-term success. Most new traders fail for 3 main reasons: using untested or no strategy, lacking trading discipline, and poor money management. Trading based on hearsay or emotion leads to losses. By using a proven strategy, you remove the emotional element and make binary, calculated decisions. Always have a stop-loss in place and never risk more than 3% of your capital on any trade. Effective money management is the backbone of successful trading. Use the 3-1-0-0-0 rule. Never risk more than 3% of your capital on a single trade and keep your per-point risk as low as possible. Always use stop losses and adjust your position size to fit your risk tolerance. This discipline protects your account from catastrophic losses and ensures you can stay in the game for the long term. Now that you've learned these 9 advanced trading strategies, it's time to put them into practice. Start by focusing on 1 or 2 methods that resonate with you and backtest them thoroughly. Continue learning about risk management, fundamental and technical analysis, and refine your discipline. Remember, trading is a journey, and consistent improvement is key to long-term profitability. In summary, profitable trading is about more than just finding the right strategy. It's about discipline, risk management, and continuous learning. By applying the techniques discussed in this video and maintaining a structured approach, you can avoid the mistakes that cause most traders to fail. Stay patient, stick to your plan, and let your winners run. Here's to your trading success.